Welcome. Today, we're going to dive into the incredible story of how India's economy went from being on the absolute brink of collapse to becoming a global financial powerhouse. It's a real journey from crisis to confidence, and it all kicks off with a simple, but frankly, terrifying question. I mean, seriously, what if your country just ran out of money? No cash to pay for essential things like oil to keep the lights on or medicine for hospitals? It sounds like something out of a disaster movie, right? But this was the reality for India back in 1991, and that crisis would change the nation forever. So, yeah, our story begins right here with the 1991 balance of payments crisis. And this wasn't just some economic slump, it was a moment that fundamentally reshaped the entire country's future. Just take a look at this timeline. It all started when the Gulf War made oil prices skyrocket and India's import bill went through the roof. By June of 91, things were so bad that India had barely enough foreign cash to pay for 3 weeks of imports. I mean, just imagine that. The situation was so desperate that in July, the country had to physically fly out its own gold reserves just to get an emergency loan. So how in the world did India pull itself back from that edge? Well, the recovery wasn't just about getting emergency loans. It required a really deep look at the national books. And to really get it, we need to understand the tool countries use to track all their financial dealings with the rest of the world. Think of it as a national report card. And that scorecard, it's called the Balance of Payments, or BOP for short. It's basically the master ledger that records every single dollar that comes into the country and every single dollar that goes out. Okay, so this chart kind of breaks it all down for us. The BOP has two main parts that have to, well, balance. On one side, you have the current account. That tracks all the day-to-day stuff, like trade in goods and services. You can think of it as the country's income and expenses. On the other side is the capital account, which is all about the bigger, long-term money flows, like investments and loans. So let's zoom in on the current account for a second. It tracks the money we earn from our exports, things like software services or manufactured goods, and all the money we spend on imports, like crude oil and electronics. Sounds simple enough, right? But for India, this is where the real challenge has always been. You see, for most of its history, India has had this, well, let's call it a spending habit. We've consistently spent more foreign money than we've earned, and this creates something called a current account deficit, or CAD. It's really just a simple balancing act. Think of it like an old-school scale. When the value of our imports, that's the blue side, is heavier than the value of our exports, the green side, the whole thing tips into a deficit. It means more money is flowing out than flowing in. And this chart, wow, it really tells that story. For decades, as you can see, India has been in the red. Now, you probably spotted that little green spike there in 2021. That was a super rare surplus, but it wasn't actually because our exports went crazy. It was a total anomaly caused by the pandemic when all the lockdowns just crushed our demand for imports. Which, of course, leads to the million-dollar or maybe billion-dollar question. If we're always spending more than we're earning from the rest of the world, how on earth do we finance that gap and pay our bills? The answer, my friends, lies in the other half of that balance of payments sheet. You see, after the shock of 1991, India got really serious about systematically building a financial fortress, using its capital account to pile up something called foreign exchange, or forex, reserves. Right, the capital account is where we track all the money coming into the country for investment. This is how we attract capital from other countries to fund our spending gap. But as we're about to see, not all foreign money is created equal. Some of it is way more reliable than others. So let's break down the difference. On the left, we've got foreign direct investment, or FDI. This is the good stuff. It's long-term, patient capital. Think of foreign companies physically building factories and offices in India. It's stable. Then on the right, you have foreign portfolio investment, or FPI. This is money going into financial things, like stocks and bonds. People often call it hot money because, well, it can flow out just as fast as it flows in, which can be pretty risky. To build a real fortress, you need a lot more of that stable FDI. So how did India attract all this stable capital? Well, that 1991 crisis basically forced its hand. India adopted what's known as the LPG model: liberalization to cut all the red tape, privatization to sell off clunky state-owned companies, and globalization, which opened up the economy to foreign trade and investment like never before. And that, opening up the economy, that was the absolute game changer. It allowed a steady stream of dollars to flow into the country, which the central bank then used to build its ultimate defense against another 1991-style crisis, a giant pile of foreign currency.
So let's just remind ourselves where we started. Back in 1991, reserves were so terrifyingly low they could cover less than 3 weeks of essential imports. I mean, that's living on the financial edge.
And now, here is the transformation. Just look at that graph. After decades of bumping along near zero, the reserves just took off after those reforms, climbing higher and higher and higher. This one chart tells the entire story of India's newfound stability. And that brings us to today. The number? An absolutely staggering $696.6 billion. We went from less than 3 weeks of import cover to nearly a full year's worth. This isn't just a number, people. It's a financial fortress that gives India real confidence on the world stage. Okay, so the fortress is built. The defenses are strong. What's next? Well, with that stability locked in, India is now looking at the next frontier. It's not just about playing defense anymore. It's about projecting influence. And the new big ambition is to take the Indian rupee global. So what on earth does that even mean? Well, in simple terms, it's about encouraging other countries to actually use our currency, the rupee, for trade and investment. The big idea is to slowly but surely reduce our own and the world's reliance on the US dollar for every little international transaction. And why does this matter? Oh, the benefits are huge. It means we're less exposed to the crazy swings of the US dollar, which can really shield our economy. It also lowers the risk of ever running out of dollars in a crisis again, like in 1991. And that gives India way more economic independence and a much bigger voice on the world stage. So when you connect all the dots, it's just this incredible story arc, from literally pledging the family gold just to stay afloat, to now building one of the largest Forex fortresses on the entire planet. It's a powerful story of learning from a near-death experience, and then methodically building resilience for over 3 decades. And all this brings us to one final massive thought. With such a stable foundation and this growing global ambition, the journey is clearly not over. So the big question now is, could the Indian rupee, once a symbol of near bankruptcy, one day actually become a true challenger to the dominance of the US dollar? Now that's something to think about.